the International Monetary Fund recently forecast India's growth from 7.2% in 2014 to 7.5% in 2015. In fact, the World Bank went a step further to say that growth could even touch 8% by 2017-18 if backed by significant acceleration of investment. So the theme for our next panel discussion, that's in fact the grand finale for today, is called, Can India Be a $5 Trillion Economy?
It's a fairly eminent panel out here to talk about not whether India can reach the $5 trillion mark or no. I don't think there is any doubt about that. If at all there is a doubt, the doubt is about when can India do that and what should, say, people like you and me be betting on for this to happen. So let me kickstart the discussion with you, Prabhat. IMF saying that 7.5 for next year and around these levels for the next 4 or 5 years. Jayant Sinha saying that it could well be 8%. Arvind Panagaria saying that, hey, it could be 10 to 12% as well for the next few years. So the opinions are divided right down the middle, so to say. Again, the point is it's not a question of whether we'll reach there or no. The point is how fast can we reach there?
I think the starting point obviously is something that one wonders about. I mean, we don't feel like 7.5% right now, but that is a new number we're working with. So I think there are two elements to it. If you compound it, I mean, long term we have compounded at, well, in the period when global growth was also good, we were compounding at 8-9%. So I think 7-8% is something which is not out of question. I think what we took to get here in the last sort of growth round, it'll probably be a bit slower. Because I think the start will be a bit slower, and then we'll accelerate as the investment cycle picks up. So I think if you compound at about 10%, 8, 9, 10%, then you're talking about maybe 8 years, 8.5, 9 years. So,
what are the challenges that you guys foresee? I mean, you speak to corporates day in, day out. You invest in a bunch of these companies as well. And I would take the listed space as pretty much the benchmark of what top corporates in India would be doing. What are the challenges, if at all, do you see to this quote-unquote magical figure?
I think the real challenge, what you've seen in the last 3 years, I mean, what the corporate houses have suffered is slowdown. We have seen a slowdown in the economy, but real challenge in terms of execution. A lot of projects, which were set up in the power sector, in the metal space, are still struggling. I mean, a lot of capex has already gone into it. And we have seen projects stuck because of, initially it was because of environmental reasons. We have seen power projects getting stuck because of availability of coal not being there. I think some of these issues are now getting addressed. We've seen the auctioning of coal blocks, which should revive some of these power projects. And the environmental side also, we are seeing clearances coming through. So I think as we see some of these stuck projects where money has already been spent starts to revive, I think that will give confidence to the current investors or the promoters to really make fresh capex. So and that is going to be the first leg of growth, where the existing stuck investment will start to be productive and adding to it, and that could be leading the growth to the economy.
Manish, I still think that in discussions like these, we kind of put the ball squarely in the government's court. If the government does X, then the economy can grow. If the government does Y, then the economy can grow. What if the government doesn't do that? Are we then saying that, hey, that $5 trillion mark or a 6-7% GDP growth is out of the way completely?
I think, to answer your question, yeah, clearly government support is required. But if that's not the case, probably it will take, instead of achieving their target in the next 7-8 years, it would take 10 years. I mean, not bad, I would say.
So, Nimkumar, we talk about, at every point of time in the last 3 months when I've spoken to market experts, they have said that they were expecting 5 reforms. What the government has delivered is 3. They were expecting, say, 7, and the government has delivered 5. How many ticks would you give on that front? And do the next 12 months put us on the track for achieving, be it 5 trillion, be it 4.5, be it 6 trillion by 2025?
Clearly, I think that, a few things, they have got the momentum right, but it will take some time. For example, the coal block auctions, by the time it translates into higher coal production, it will take at least 6-8 quarters more, right? So the subsidy reduction plan through UID, that process has begun. They'll have to ensure that more and more schemes get linked to UID in the next 12 months. They have to ensure that this GST is legislated because it's going to be very important, howsoever diluted it may be, for productivity improvement in this economy. India is a supply-short economy. If you go back to India's history and see, every time growth comes back, inflation comes back because you don't have enough resources. So therefore, my hope is that given the momentum that we have seen, in the next 12 months, they should be doing all of this. And by the middle of next year, hopefully after the next budget, the picture will become clear whether how soon we are going towards the goal of this $5 trillion.
Sure. And to your mind, what are the other challenges? We've discussed what the government needs to do and how stuck a few things are. What else aside of that?
No, from government side, I think we're going to be doing something about financing because a large section of the financing market is dominated by PSU banks, and it's a large bad bank lying within them. So somewhere, kind of a good bank, bad bank, structure. Somehow the banking system has to be quarantined because unless the system needs to lever up incrementally for it to pump growth. And if large financial intermediaries are stuck with big NPAs, they would not be, the lending standards wouldn't be loosened. So there's been whole argument about why policy rates are not being transmitted. They won't be transmitted because the lender is not feeling good about it, and he's stuck with large NPAs. So you got to create enabling conditions for them. All other conditions are in place. So I'm fairly optimistic in terms of how over next 2, 3, 4 years you would grow, and you will grow at 7, 8, 9%. The larger point in India, of course, is that would you be able to sustain this for next 1 or 2, 3 decades as Japan, China, Korea did? And if you're able to have these institutional reforms that a lot of these gentlemen are talking of, we would be able to have it in place.
Gentlemen, all of you, thank you so much for being a part of this discussion, and thanks so much for joining me.
Well, that brings us to the end of this second edition of Birla Sun Life Mutual Fund presents Voyage, powered by ET Now. This event would really not have been possible without the support of a number of people, and to thank them and to conclude the evening, I'd like to call upon Mr. Deepak Gupta, Co-Head Retail Sales and Distribution, Birla Sun Life Mutual Fund.
I would like to start my thanks with the esteemed guest who graced the occasion. A special thanks to all the external speakers of the industry. Moving on to a big thanks to Mr. Nitin Gadkari and Jayant Sinha for sharing their views on the government policy. The thanks will not be complete if we do not thank our own Mr. Balasubramaniam, because it starts from there. The way we say, that it flows from the top. And Bala has been the guiding force for all of us. Our gratitude to our media partner, ET Now, on-ground partner, Sunshine Event. Thank you very much.
It's time to hear from another policymaker. We're very happy that Mr. Jayant Sinha, Minister of State for Finance, took out some time to send us a message from his constituency, Hazaribagh in Jharkhand. He's a former investment fund manager himself and will tell us how the government is transforming the economic infrastructure in the country to ensure that the environment remains pro-business and pro-investors. Let's listen in.
I'm very glad that I've had an opportunity to be able to speak to you about all the exciting changes that are happening in the Indian economy. As I'm sure you're well aware, on February the 28th, we presented our budget to Parliament, and this was a very long-awaited budget because expectations were quite high that we would lay out our economic roadmap and the direction in which our policy making would be focused for the next 4 years in this budget. I'm very glad to say that we did in fact do that, and it was met with quite a bit of approval in terms of the thinking, the philosophy and the roadmap that we laid out in the budget. But with this policy making now out of the way, what we are really focusing on now going forward is execution. and really making sure that all of the policy work that we've done actually make a difference at the ground level. And that is our very, very high sort of focus right now. That is a very important priority, and that's really what we are working towards. Now, as we are working towards this, there are 3 or 4 things that are very important. But across the bureaucracy, across the judiciary, we're trying to ensure that all the bottlenecks are dealt with, number 1. Number 2 is to ensure that the rate cuts that the RBI has done are transmitted through the banking system. The third very important thing that we are doing is that we're trying to get the stalled projects, and there's about 1,400 stalled projects that amount to somewhere between $150 to $175 billion right now, that really are not getting going. Now, this is obviously quite injurious for the economy, quite damaging for the economy, and so getting these stalled projects going in terms of an execution approach is extremely important. The fourth area that we are focusing on is to put in place the land acquisition bill. So once we can get the land acquisition bill passed in Parliament, we'll be in a position where we can get many of these projects that we are thinking of from a greenfield perspective off the ground. The fifth area that we are monitoring from an execution point of view is GST. Now, GST is a real game changer because it enables us to get rid of a large number of indirect taxes that are very different from state to state and replace all of that with one single destination tax. So that's really our focus right now. As I said, the policy making work we think was done quite well in the budget. The budget has established now the roadmap that we want to pursue, and so the focus for the government really is now execution and really ensuring that we can get the economy roaring along at 8 to 10%. Thank you very much.
Also, promising words there from Mr. Sinha that execution is, going to be the sole thrust for the next couple of months, in fact, maybe the next year or so. Ladies and gentlemen, we've spoken at length about the India growth story and the optimism around it, and there's absolutely no doubt that the possibilities are endless. So the theme for our next talk is India's growth potential. What next?
Up until now, we've talked about the strategy Birla, Sun Life, AMC as a house has followed, what has differentiated them from the industry, and how they've managed to beat not only their individual benchmarks but also competition. But with Manish, we would like to get into the core thesis of the India story, the nuances, the risk-reward, and where is the opportunity. So Manish, before we get into specifics, let's talk about the India story as we speak. Everyone is of the view that this is the place to be in. If there is one story in the world, it's actually India. So if the India story is so shrill, what explains the recent bout of volatility? 2015 has been a volatile year, up, down. We've seen peak and troughs.
Well, Nikunj, nothing goes up in a straight line. And it's like when you're making an omelette, you have to split the egg as well. So given that this market's had a healthy run, I think it's great for us that either we consolidate and go sideways this year, or hopefully we get a correction so investors can come back into the market. And maybe it's 5 or 10% down, and it won't happen in one day. It will be rotational, different sectors, different stocks will do it at different points.
So every decline is like e-commerce Flipkart sale.
Yeah, you think of it this way, that we are now getting to about a $2 trillion economy. We will create the next $1 trillion within 5 years. So that's a 50% rate of change in the economy. And you know that the productive sectors of the economy which are represented in the stock market typically do better than that. So in 5 years, if the listed stock market entities don't do 2x of that, I'd be very surprised. So if you take the larger opportunity set, in a $3 trillion economy, you will save about 30%. So there'll be $1 trillion of saving in India every year. Historically, half of it went into gold and real estate. With the disastrous performance you've seen in gold and real estate doing nothing, you would expect money to come back to financial assets.
So do you think the new administration has, in a way, reset the entire saving paradigm? Gold is not going anywhere. For the moment, real estate returns are giving you, real estate investments are giving you negative returns. Money has to move back into either mutual funds or perhaps other financial savings?
Yeah, so it's not about the government. They haven't done anything to gold prices. It's an international phenomena that commodities will correct. And in every bull cycle over the last 40 years, the asset class which led in that 10-year period underperform severely in the next 10. In terms of our equity environment, I can't think of a better place in the world with zero long-term capital gain tax. Which other asset, including a bank deposit or anything that you do, the government is virtually telling you, please come and make money over here. And the government has moved decisively, at least in the West. You are finding most governments are going towards the left and becoming more socialist. If you are a government which has to turn this country around for, from a particular mindset which was socialist in its orientation and distribution, tax and spend, as opposed to become a smaller government, minimize taxation and let money flow into consumers' hands and entrepreneurs' hands, it's a radical shift taking place in the country. So I'm very hopeful. In my career, I haven't seen a confluence of economic events with a government in place, commodity prices falling, entrepreneurship being unleashed, and valuations not excessive. This is a great golden period to be investing in India.
Final question, what is the biggest risk for this market?
Risk in the market is a risk to a business, because if you can digest a loss, if you're not levered, it doesn't matter. As long as the business performs, your price will come. So even in 2008, our market went down to what, 8,000 or thereabouts. And within, I think, 12 months, we were back to 11,000 or 12,000, which is where we may have started the collapse from. The reality is, the 6-8 billion people in the world won't stop consuming. These businesses won't go away. It's that temporary valuation which will be affected. And where there is scarcity, there will be value. So as long as you've not bought at ridiculous price and you're not levered, it doesn't really matter.
And if somebody's buying into stocks right now, valuations are on their side. I mean, the game is loaded in the favor of an investor.
Yes, if you have a time horizon, time is on the side of a good business, because the good businesses by definition compound at 25% or thereabouts. So if you give it enough time, in 3 years you're going to be 2x.
So your broad message to the audience and the viewers is that take that leap of faith. It's important to participate.
I think in India, the sad thing is, our average age is 24, 25, which means in a asset allocation mix, it should be 75, 80% of our allocation should be to risk assets and equity.
Which is the
Unfortunately, we are in India behaving like we are 75-year-old people. And we have money in fixed income or we have it in gold. And I just wish as a country, because the wealth in India is actually being cornered by the foreign investors, because they are owning bulk of the equity of the best companies and the Indian investors don't have it. So either go and start your own business or buy equity of good businesses. That's really the way to create wealth. You can't become rich by having fixed deposits. You certainly can't become rich by having gold. And if you're buying real estate on leverage, and if this crisis happens, think what happens to you.
Like they say that the ship is always safe in the harbor, but it is meant to go for the high sea. So it's important to really take that risk. So it's lovely to see the audience is believing in India's story. But if you are a half-hearted believer, I guess the message from today's entire sort of seminar is that be a firm believer. Let's put our hands together for Manish, Chokhani, and you've been a great audience.
Ladies and gentlemen, it's a pleasure to have you all with us at the second edition of Birla Sun Life Mutual Fund presents Voyage, powered by ET Now. Next up, we have an exciting discussion coming up with a fund managers panel. They'll be talking about superior returns and maintaining consistency of returns across funds.
I'm really glad we have these four gentlemen on the panel, because the idea was to put together fund managers with different styles so we can have a conversation about the different kinds of fund management that it takes to make the most of a market like this one, which is, I think, what we all want to do as investors, is to make sure that we don't miss out on any opportunities in a market like this. And I think that's the whole point of this fund manager conversation, is to understand how each style works, to stay on top of the information, to stay on top of the market, and to look after each of your investors, who's the final stakeholder in all of these conversations. All right, I want to start with asking Anil simply this. The Birla Sun Life Equity Fund has been a solid performer. What is the core formula that you're using day in and day out to make sure that you stay on top of everything that happens?
The last 6 months, and obviously, as you know, have not been too easy on me, particularly given the fact that valuations and getting growth at reasonable valuations have been a bit challenging. But the way I function is basically to look at primarily growth at reasonable valuations, to look at businesses which are very strong moats, businesses which have very, very strong entry barriers, large market shares, and then make an exception on those businesses, even though the valuations may not necessarily be of very high comfort level to me, but they have tremendous entry barriers. And the last but not the least, I just love deleveraging stories, and I kind of pile up pretty heavily on deleveraging stories, because to me those are stories which are very attractive from a medium to large perspective, because you also get to play some bit of a re-rating where you keep the enterprise value constant, but you're repaying debt, and that part of the debt also goes to market cap, and that's the way the investor earns.
This is a question I have for each of you, and I'm going to ask each of you this is, if I'm an investor who picks your fund today, ideally what sort of a time horizon would you like me to have?
A minimum of 3 to 5 years, because as I said, deleveraging does take time, and once you have a deleveraging as a turnaround, and then then the higher growth rates start coming in, you get a further re-rating. So from that perspective, ideally, you would like an investor to be with me for 3 to 5 years.
I may add a bit here. Like the saying goes, the time to sell a good stock is never. The time to sell a good fund or a good fund manager is never. So we would want the investors to stay in for a long period of time. But from investors' point of view, to catch they get the maximum benefit of the fund manager's stock picking ability, sector selection ability, portfolio construction and delivery ability, you have to give fund manager 3 to 5 years so that you can get maximum out of the fund. And that is the time horizon that we're looking for.
All right. I want to bring Satya in here because, yes.
If you look into it, you say that what should be the investment horizon? Everybody says 3 to 5 years as a general term. But if you take the example of tax relief 96, if you would have held it for the last 19, 20 years, you would have got 104x. So I don't think there's a time horizon. As long as the fund on a 3-year, 5-year basis continues to deliver, then there's no reason to sell or get out.
So I want to ask you also about the fund that you manage, which is the Advantage Fund. So if I'm a regular investor or I'm a distributor talking to an investor right now, ideally, what sort of information is available in the public domain that I can use to illustrate the difference between funds like these?
The way I manage Birla Advantage Fund is that we look, if I put it, it's more like playing the business cycle. We try to identify the emerging trends within the business cycle, and we try to forecast which are the 3-4 sectors that we think are significantly going to outperform the broader market, and allocate a large proportion, almost around 70 to 75% of the fund corpus into these 3 or 4 sectors. So what does it result in? It results in the fund being benchmark agnostic, sector agnostic, and as we are investing in few sectors, it tends to have higher mid-cap allocation than other diversified funds. And as far as the stocks go, he is GARP, I'm pure growth. So I like to invest in companies which, according to my or our fund house and estimates, can compound by around 25%, both on the top line and bottom line for the next 3 to 5 years. Consistent compounding stocks, high quality, high ROE, ROC. That is.
One of the funds I was really excited about talking about was the MNC fund. This is a fund with a great track record, 104% over the last 1 year at least. Tell us the thought process behind how these stocks are picked.
You were to talk about the MNC fund, which says the company has to be promoted by global majors, present across geographies, right from emerging to developed ones, present for multiple decades, and should be having relevant products and should be knowing what kind of product to be sold and introduced at what time frame. So they don't waste their time and energy, and it is like they have it from their parent and they sell it.
The mid-cap fund and the small-cap fund. Now again, the reason why I've been wanting to ask this question for a while is because there's now a lot of analysts and on daytime markets television who will tell you that mid-caps are overvalued and it's time to get out and there's no value left in any of this. We're getting questions from investors who are asking us, is that now true for mid-cap funds? At what point do I start up and stop my SIP in a mid-cap fund in order to stay on top of the valuation? And while, the advice normally is that if you've started an SIP, the whole point is to keep it going. I want you to answer that question for our viewers.
No, I would disagree with the proposition that mid-caps in general are overvalued. Mid-cap, mid and small-cap universe is evolving, and it's evolved significantly in the last decade or so. And I can make the statement that the Indian structure of the Indian equity markets have changed significantly. To give you one data point, there are around 300 to 500 stocks in this space with a total combined market capitalization of around $350 to $400 billion. Enough in appetite, enough juice for investors to play with. So when I look at valuations of large number of companies, which some of them are in our portfolio, and we have 50 to 60 stocks in our portfolio, I don't find valuations for mid-cap companies over or high compared to large cap. In fact, our sense is that we've got many companies where the valuations are very, very juicy compared to the growth rates that some of the mid-caps companies are likely to achieve. Now, a bit about why some of the valuations of some of the mid-caps may be high is because of the growth opportunities. With a 3 to 5 year view, I have no doubt in my mind that the earnings growth for mid and small cap companies will be far, far higher than the large cap. And in that context, I would argue that mid-caps are not overvalued. They are fairly reasonably valued.
For me, this has been tremendously educational to actually meet the gentlemen who, manage these funds, who manage our hard-earned money on a day-to-day basis, and find out how they're thinking and what they're thinking about when they decide what to do with our money. Gentlemen, thank you so much.